Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. Yesterday I made a video about stock crash prices and where I thought some of my stocks could go in a worst case scenario. And that was a fun hypothetical calculation that just gave you some idea of how far stocks could fall in the event that things just kind of go back to the mean average of what we've seen in forward PEs in recent history. So that video was kind of like the results of what would happen in a major crash, correction, pullback, however you want to identify with it. Today, though, I want to talk about my personal opinion on how a crash correction would occur in the stock market in 2021. This is me speculating on my own after having watched the stock market for several years now and economic activity and all the things I read and share with you. And in my opinion, right now, the biggest risk in the stock market is what I'm calling the paper hands crash. And if you don't know what paper hands are, they're the opposite of diamond hands. Which kind of came into popularity here in 2021. Diamond hand folks are going to ride a stock up or down all the way because they have a very strong conviction. On the opposite side, you have paper hands, which generally are just folks who are in it to make money in the short term, any sort of weakness, and they're going to bail. As soon as they hit their price targets, they're going to sell. But I think it's the paper hands that have a chance to really let us down here in the summer heading into 2022 as the world reverts back to normal. And the backbone of my paper hands thesis is really just the incredible amount of new investors we have in the stock market world. It doesn't take very long to click around YouTube and see a lot of fresh new faces who are running channels on investing. You've got thousands of new Discord channels. You've got Reddit boards that are at record traffic levels. We have a lot of new money in the stock market, and that is a good thing. And just to give you some idea of how many new accounts we're talking about, this article from Barron's, Fidelity has added approximately 2.26 million accounts in 2020. Robinhood, which is currently a private company, but it is noted it has added 3 million accounts to reach 13 million total accounts. This quote from Vanguard has experienced record growth in retail accounts this year. They do not disclose their numbers, but obviously a bullish sign. And back to Fidelity, which is a major player, they're also seeing an uptick in trading volume. Equity trading more than doubled year over year to 2.3 million trades per day on average in the second quarter. And compounding the support of retail investors is this survey here that notes that 43% of retail investors are trading with leverage. According to a Yahoo Finance Harris poll published on September 9th, 2020, 33% of people holding stock indicated they've been trading more since the pandemic began, and a similar number said they are trading individual stocks more as opposed to ETFs. On a similar note, 36% indicated they've increased the amount of stock exposure in their portfolio, and respondents with household income less than 50K said they traded more frequently since the pandemic and had more stock exposure, even more than the $100,000 income level. So trading is up, single stocks are up, and the overall market exposure is up. Interestingly, the bullishness has pushed some retail investors into the world of leverage. 43% of retail investors said they are using options, margins, or both. Okay, so the point of all those facts is really just to illustrate, we have a lot more money in the market right now. We have a lot more traders in the market right now, certainly than we've ever seen in times before the pandemic. In theory, this is a wonderful thing because it means a new generation of people who have not been investing are currently investing, and it stands promising for the future, assuming that they hang on to their investments for the long term. But there's another snake in the grass out there, if you will, and I think it's temptation. The temptation of spending some of your newfound investment money is going to be a thing in 2021. Don't forget that America's consumer marketplace is very competitive, and we have built brands from nothing into absolute Goliaths. Think of Coca-Cola and Pepsi, just to name a couple there. We are good at making you spend your money in this country, and that has been proven time and time again. This is the chart of real personal consumption expenditures for the United States over the past 10 years. So 2010 through December of 2020. And this is what America does. We spend, spend, spend. Inflation over time makes things more expensive, so our spending continues to compound. We also evolve and make more money, both on inflation and increasing opportunity in the labor market. And you can see that all the way up to the pandemic here, which was February 2020, it's basically been a straight line. Now, no surprise, pandemic, lockdown, etc., and spending bottomed out here in April of 2020. And as we all know, it slowly bounced back up through the summer. But if October 2020 was the peak of bounce back spending, it never even matched the levels that we saw in February. And even though the data's not out yet, I'm going to guess that January and February are either at or below December's line, just because of the weather. We had more pandemic cases pop up, and generally speaking, January and February are just slower for economic activity. Now we have the personal savings rate over the same stretch, 10 years, and you can see, no surprise, that in April, our personal savings rate reached an all-time high, quite frankly, because there was almost no way to spend your money with lockdowns and whatnot, and it has went down as spending has escalated. But even here in December with a 13.7% savings rate, that's far and above anything we've seen outside of this December 2012, where you had a 12% savings rate. This article by the New York Times does a good job illustrating why markets boomed in a year of human misery. It wasn't just the Fed or the stimulus. The rise in savings among white-collar workers created a tide lifting nearly all financial assets. Scroll down a little bit. They have a couple cool graphs. This one's interesting. Personal income actually increased in 2020. And they're basing that, even though wages fell minus 43 billion, unemployment insurance benefits rose by almost 500 billion. The CARES Act, as they note here, had a part of that. Stimulus checks added plus 275 billion. Proprietors' income, which would be small business, that was even up by 29 billion, and they make a note here that is mostly because of PPP loans. And then all other income, which can include investments, was up 265 billion. So at the end of the day, disposable personal income was up $1 trillion versus lost wages of 43 billion. Now, in that same article, they look at how spending decreased. Durable goods up 60 billion. They're saying gym equipment. Non-durable goods plus 39 billion, which includes food, as they note here. Services down 575 billion. Interest payments and miscellaneous outlays minus 59 billion. Put that all together, and total household outlays minus 535 billion. So no matter what fact source you buy into, the bottom line is that savings rate is up, spending is down, both of those by huge proportions. Plus, we have an unbelievable inflow of investing dollars by new market traders and folks like me who have been in the market for a while but have simply added more money for all the reasons everyone else is throwing money at the stock market. So where does my paper hands crash theory come into play? Well, it's actually quite simple. We have had limited opportunity to spend money. America is not very good at saving money. And while some folks will have learned new habits here in 2020 and the beginnings of 2021, the fact remains that temptation will be pulling money out of the market. Take your pick from simple things like restaurant dining, Disney World, movies, sports games, concerts, weddings, you name the reason, and customers are going to be separated from their savings dollars in 2021. In my opinion, a lot of those dollars that are going to flow back into the economy on the activities I just mentioned are going to come out of investment accounts. Even so-called diamond hand investors who have made, some of them over 1,000% on Tesla, can they avoid the temptation coming into summer and fall of feeling like, hey, we've just been through a lot. I made plus 1,000% in the stock market. Don't I deserve a treat? Then you have paper hands who were never obligated to stick around for a long time. Once the right opportunity comes up for them, it could be a concert, a vacation, an engagement ring. They're going to take the first opportunity to spend their money, and it's going to come out of their investment account. The other pressure that's going to be on investment accounts over the summer and into 2022 is the fact that we've kind of lived in this world where savings accounts are lame, right? Or they don't really pay. So you need to be invested or you're actually losing money. So the level of savings that actually lives in a Robinhood or Fidelity account is fairly extreme compared to what most of these folks hold. So when opportunities do arise, that is the cookie jar that will probably be rated. Okay, so if what I'm saying comes true, what happens to the stock market if everybody starts pulling some of their dollars out? Doesn't have to be all of them. They can pull out 20%, 30%, 40%, even just their stock market gains and leave in their core investments. The concern with that activity is it starts to show weakness in the market. Then you get the folks who freak out about every 3% dip and they start pulling their money out of the market because they're in the same situation too. They're thinking about a new vacation or a new house and they're okay with the stock market, but God forbid it drops 3 to 5% in a given week. They're pulling everything out and then that snowballs the problem. So in my opinion, the paper hands crash is our biggest risk. I do think corporations are going to continue to post strong profits. I do think we'll see some of the value plays continue to rebound. And we are going to start to see what we've been saying for the past several months, which is the stock market is not the economy. And the thing that's going to happen is the economy is going to be awesome and the stock market is going to flip the script and it could suffer or flatline a little bit. So that's my theory on a paper hands crash 2021. I think it comes sometime in summer or fall, and not because companies are having bad performance, but because people just slowly but surely exit their positions and give themselves a treat for everything that they've lived through in this past year. All right, guys, let me know what you think of my paper hands theory in the comments below. Thanks for watching. We'll see you on the next video.